Are you ready to read financial statements like a pro? Why bother? Well, your financial statements on your tax return. So the more accurate your financial statements are, the more accurate your tax return will be. I'm Mitzi Sullivan, CPA, and founder of Facts, Figures, and Fallacies from the Front Line. Today, we're going to look at reading financial statements like a pro. I'm tailoring this to small business owners who already understand the basics of financial statements. My goal is to help you uncover deeper insights through self-auditing techniques, trend analysis, and cash flow forecasting. This will not only improve your decision-making, but it will help ensure accurate tax returns and that you pay the lowest possible income tax. So how often should you perform a trend analysis or look at your financial statements? There are advantages of doing it daily, weekly, and monthly. If you can't do anything except for monthly, start there. The nice thing about the daily trend analysis is it helps you to catch errors immediately, and that way you can stop repeating those errors before you make a big mess. I like the weekly trend analysis for monitoring operational consistency and identifying emerging issues. And then monthly reviews provide a comprehensive overview and help detect patterns of fraud or misstatements. So these frequent trend analyses ensure that discrepancies are addressed promptly, and that reduces the risks of compounding errors and enhances the reliability of your financial statements. So how does an accountant perform these trend analyses? I always begin with the balance sheet. So many small business owners overlook the importance of the balance sheet and they focus only on the income statement. But accountants understand that if there are issues on the balance sheet, there are issues on the income statement. So I like to go line by line, starting with cash. Make sure your cash accounts, your bank accounts have all been reconciled. And then check those reconciliations to make sure that there are no stale reconciling items. And what I mean by stale reconciling items would be deposits in transit that never cleared the bank. Maybe you're doing a May reconciliation and you have deposits from April that haven't cleared the bank. Those are errors and they need to be corrected. Maybe you have checks that are outstanding and they've been outstanding for 2 or 3 months. Those are also most likely errors and they need to be corrected. The sooner you make these corrections, the more effectively we can stop future errors from occurring. And then once all of my cash accounts are reconciled, I'll move on to the next asset on the balance sheet. And let's just say that is accounts receivable. Look at your accounts receivable aging detail. If you have a significant amount in over 90 days, look at your accounts receivable aging report. If you have a significant balance in your over 90 days, that may indicate that you are not recording your transactions correctly or that you need to do some collections. Don't let your accounts receivable get out of hand. Next, we'll look at the next item on the balance sheet. Sometimes that may be inventory. Make sure you're doing an annual inventory at year end. I think that a lot of small business owners don't realize that your inventory on the balance sheet, that balance affects your net income dollar for dollar. So if you're letting inventory build up on your balance sheet that you don't own, you most likely are significantly overpaying tax because your cost of goods sold is sitting on the balance sheet and it should be on the income statement. So moving down the balance sheet, we've hit cash, we've hit accounts receivable, inventory. Look at your fixed assets. So you don't need a line item on your balance sheet for every fixed asset you've ever purchased. One fixed asset for vehicles, one for equipment, one for buildings, one for land. That really is all you need on the balance sheet, but you need a depreciation schedule. And your totals on the balance sheet need to tie out to your depreciation schedule. If they don't, most likely you've purchased or sold an asset and you're not getting credit for it on your tax return. Or you've purchased assets and they have disappeared. So just like you take a physical inventory of everything that's sitting in inventory, you want to take a physical inventory of everything sitting in fixed assets. And the best way to do that is have a detailed fixed asset listing, which lists all of those fixed assets that you own, what year they were purchased, VIN numbers, etc. And then do a physical inspection to make sure that list is correct. Always make sure that your detailed fixed asset listing agrees to the total fixed asset on your balance sheet. Then you also want to look at accumulated depreciation. This is very important You need to be tracking accumulated depreciation on a book basis, on a tax basis, and on an alternative minimum tax basis. And if you don't enter these balances correctly, that'll throw off your tax return. So make sure that just as you tied out your fixed asset balances from the balance sheet to the fixed asset detail, make sure you tie out that accumulated depreciation number to your fixed asset detail in your depreciation schedule. Once you get through the fixed asset section, see if there are any other assets that are listed on your balance sheet. You may have long-term investments. You may have receivables from shareholder. You may have notes receivable. Make sure all of those balances tie to the detail. Don't let those balances build up and don't let them go negative. If you see a negative amount other than accumulated depreciation or reserve for allowance for doubtful accounts, if you see a negative amount on the asset section of your balance sheet, that is most likely an error. So once you finish with your asset section, move on to your liability section. And the first line item on there will probably be accounts payable. Just as you did with accounts receivable, fill up an accounts payable aging summary. Again, if you have a significant amount in the over 90 days column, you probably have errors, or you're behind in paying your bills, or have significant cash flow problems. So review that accounts payable detail. Make sure that the summary agrees to the balance that's on your balance sheet. And then you're ready to move on to the next line item on the balance sheet in the liability section. Most likely that will be accruals. Maybe you're accruing rent expense that hasn't been paid yet, but maybe you're accruing insurance. Just make sure that you can support each one of those balances. If you can't, that will directly affect your income statement, which will directly affect your tax return. Then move on to your notes payable balances. The biggest mistake we see here is business owners that apply the entire note payment to the note payable balance, and they're leaving out the interest section. So at the end of the year, you should be able to tie every single balance in your notes payable to the bank or to an amortization schedule. Make sure every single balance is correct. If your balances are not correct, your interest expense on the income statement, which goes on your tax return, is also not correct. And then at the bottom of your balance sheet, you'll see retained earnings or owner's equity. And that's a very important section as well. And I think the easiest way to check that balance is make sure that your prior year balance on your tax return, plus current year net income, plus any contributions that you've added, less any distributions that you've taken, is equal to the ending equity balance on the balance sheet. And that sounds a little confusing, but it's a fairly simple calculation. You can check that calculation in my guide that's attached in the comments. It's a very important number. If your equity section is wrong, your income statement is wrong, and your income tax return is wrong. So once you've done this analysis of your balance sheet, pull up a balance sheet trend analysis. And you can do that week to week, day to day, month to month, or yearly. And what you're looking for is a significant fluctuation that you weren't expecting. So maybe fixed assets fluctuated by $100,000 and you know automatically I purchased a $100,000 piece of equipment. No big deal. But if there are fluctuations on there that you can't explain, then you need to investigate those further. So then you're going to move on to your income statement. The income statement trend analysis is just as important as the balance sheet. So I like to do an income statement trend analysis month to month. So I'll pull up year-to-date income by month, and I'll start with the income and then move on to expenses. And in the income section, typically revenue will run consistently month to month, or if it's a seasonal business, maybe I'm expecting September, October, November, December to be very high or very low. If I pull up a trend analysis, I can make sure that those accounts are fluctuating the way I expect them to. And then when you move on to the expense section, that's very helpful because most of your expenses run consistently. And then when you're comfortable with your revenue numbers, look at your cost of goods sold if that applies to your business. Your cost of goods sold should be fluctuating with your revenue. So higher revenue, higher cost of goods sold. Lower revenue, lower cost of goods sold. And when you're comfortable with that, you've got your gross profit. You can also look at your gross profit, make sure your percentage of gross profit is very consistent. So most businesses will have a consistent gross profit margin. Your gross profit margin is your gross profit divided by revenue. That percentage should be fairly consistent month to month. So when you feel comfortable with your revenue, cost of goods sold, your gross profit, then look at your expenses. These are operating expenses, so they should be fairly consistent month to month. This is probably the quickest, easiest section of the analysis because you will have bank fees very consistent. If you have credit card charges that have increased, then you should have revenue that has increased. You will have rent, very consistent. You can see it every month. Utilities, fairly consistent. You can see it every month. And when these numbers fluctuate, you can immediately recognize where there's an error. Maybe you paid rent twice in a month, or maybe you haven't paid rent and you're behind. Also, wages will typically be fairly consistent unless you're a seasonal employer. And the ratio between wages and payroll tax expense should stay consistent. Another helpful analysis that you can do on your income statement is current year versus prior year. So look at July current year versus July prior year. And you should see fairly consistent amounts there. And you can also tell, am I above where I was this time last year? Am I below? Do I need to make some changes? And you can finish your analysis with looking at your net income. Make sure that if you have a significant amount of net income or maybe you have a loss, make sure that you're prepared for that at the end of the year and that you've paid in enough tax. If you want to get deeper into this topic, download our free guide. It's attached in the comments below. And as always, thank you so much for watching. Please like and comment. Those comments really help us to develop our channel. And also subscribe and go to our channel. You'll find more videos that are very relevant to small business owners.